Hi, everyone. Welcome to our webinar today on cross-border tax issues when moving employees to the US from Canada. We appreciate you taking the time to be here with us today. My name is Paula Owen. I'm a partner in our Calgary office, and my co-speaker is Emily Yu, who's from our beautiful Vancouver office. Morning, Emily.
Good morning, Paula, and good morning, everyone.
So a few housekeeping items. As an NASB accredited sponsor, we are able to offer continuing professional education CPE credits for today's webinar. In order to qualify, you'll need to answer all 3 polling questions that will appear during the session. These will pop up at various times throughout the webinar, so please make sure you stay tuned and respond promptly to each one. We'll provide everybody about 45 seconds to a minute to respond to those polling questions. We really encourage you to ask questions throughout the webinar using the Q&A function. While we may not address them immediately, we have set aside some time at the end of the presentation to go through as many as we can. So once the webinar ends, a short survey will automatically pop up, and we would greatly appreciate it if you could take a moment to complete it. Your feedback really helps us improve for future webinars, have topics that are relevant and topics that you want to hear. So please take the time to complete that for us. Lastly, if you'd like to enable closed captioning, simply click on the live transcript button at the bottom of your Zoom window and select Show Subtitles. I know this can be helpful if you're in a noisy environment or you prefer to follow along with text. So a little bit about Andersen. Andersen in Canada is a national advisory and professional services firm. We have offices in Vancouver, Calgary, Edmonton, Ottawa, and Montreal. And we are part of Andersen Global. So we're connected to a worldwide network of over 18,000 professionals, all experienced in tax, legal, valuation, and advisory. We have a number of service lines that we provide here in Canada that's supported with our expertise. So global mobility services, private client border tax matters, US and Canadian business tax, and estate and trust planning, just to name a few. So we encourage you to reach out to us at any time if we can be of assistance in those areas. But today we're going to focus on global mobility issues of moving employees from Canada to the US. Our agenda is going to cover tax residency rules, the tax treaty, Canadian departure tax, because that's always a bit of a worry for everybody. We'll touch on payroll and withholding issues, tax return filing requirements, and then just summarize with some best practices that we'd like to recommend. Our discussions today are based on current tax laws and treaty provisions. And of course, tax laws in both Canada and the US are subject to change. For example, if enacted, the proposed big, beautiful bill in the US that is all in the news right now could really impact how Canadian individuals and businesses would be taxed on their income from the US. So Emily, I'll let you take it away with our first topic.
Thank you, Paula. Well, Paula, would you say when a client come to us, new client or existing client, one of the first things we want to confirm is their tax residency in the respective countries. That really is critical because it determines how a person is taxed in a country. So today we'll focus on Canada and the US, of course. In Canada, most of us know that Canada imposes tax based on what is called residential ties with Canada. So if a person has sufficient residential ties, this person would be treated as a factual resident of Canada. And if you're a tax resident of Canada, you would be taxed on a worldwide basis in Canada, okay? So if you don't have enough residential ties, but if you're in Canada for a certain amount of time, for example, 183 days or more in a year, you could deem to be a tax resident of Canada. If you're deemed a resident of Canada, again, you're subject to Canadian tax on a worldwide basis. you could, if you're resident of a treaty country, in our case, the US, what could happen is that even though under Canadian domestic rules, you're tax resident of Canada, you could treaty tiebreak to the US, in which case you would be deemed non-resident of Canada. If you're deemed non-resident of Canada, you would be only subject to Canadian tax on certain Canadian source income, which we'll talk about a little bit later on. Okay, so what would Canada be considered as residential ties? There are some significant ones. There are also some secondary ones. Significant ties to Canada would include having a permanent home, having a home that's available to you. Another one is having spouse or common law partner in Canada, or having dependents in Canada, and also to a large extent if you have employment in Canada as well. There are a number of secondary residential ties. They are not necessarily ranked in in terms of the importance, but the more ties you have with Canada, the more likely that you'd be treated as a Canadian resident for that income tax purposes. Secondary ties could include coverage under provincial health, having a vacation property in Canada, having personal belongings, having cars or personal effects, furnitures in Canada, social ties in Canada. If you belong to a religious organization or recreational membership in Canada, having Canadian driver's license, okay? So if you are moving from Canada to the US, Canada would generally consider you ending your Canadian tax residency in the latest of a few days. One is when you depart from Canada. Second one is if when your spouse and dependents depart Canada, and when you become a tax resident of the treaty country. On the US side, US is a little different. So as you can tell, for Canadian tax purposes, the residency, because it's dependent on a number of or existence of residential ties, it can be subjective. US, on the other hand, is more clear. And US is one of, I think, only 2 countries in the world that imposes tax based on citizenship. So if a person is a US citizen, this person would be treated as a tax resident, at least federally, in the US. Also, if somebody holds a valid green card, this person would also be subject to US federal income tax requirement on a worldwide basis as well. And lastly, you could also be a tax resident of the US simply by spending enough time in the US. This is what is called the substantial presence test. Okay. And let's talk about substantial presence test. It is, you would meet that if you spend at least 31 days in the current year, okay, so 2025, say, but you would also count the prior 2 years, okay, so if you include all the days you spent in the US in 2025, some days could be exempt for this purpose, but otherwise you would count all of those. A third of the days in the US in the previous year, so 2024, and 1/6 of the year prior to the previous year, so 2023. So if you add all those days together, and if it's 183 days or more, you would meet this substantial presence test. And if you meet this test, you would be treated as a US tax resident. Okay, and if you made that for 2025, the residency start date is generally the first day that you're present in the US during this year. Okay, so when a person moves from Canada or from outside the US to the US, and assuming this person is not a US citizen or a green card holder, a lot of times that this person may not meet the substantial presence test for the year of move, especially if they moved in the second part of the year. And if they don't meet, so if you move in August 2025, and you don't meet the substantial presence test for 2025, that means you remain a Canadian tax resident generally. Okay. What could happen is that if you determine that it's beneficial for you to be treated as a US tax resident, you could make what is this called a first year choice. Okay. There's some conditions that you need to meet. For example, you have to be in the US for 31 days in a row, a minimum, okay? And you also have to be in the US for at least 75% of the time from the beginning of that 31-day period, okay? And assuming that you meet those conditions and then you make that first year choice, then you would be treated as a US tax resident, and you would be treated as a part-year resident of the US. So as someone contemplating leaving Canada and going to the US or any other country for that matter, what we recommend people to do is create a bright line, have a clear cut, a clear break from Canada, and try to eliminate all your residential ties with Canada to the extent possible, and demonstrate a clear timeline when they cease the Canadian tax residency. Okay. But there are times when it's not possible to cut sufficient ties with Canada, especially when somebody move out to the country for employment purposes. There are times that the spouse or children remain in Canada, or the person has to travel between the two countries, at least for a period of time. So in that case, it is possible both Canada and the US would treat them as a tax resident for under their own rules, in which case we will look at treaty tiebreak to one country or the other. And there's a series of tests you to go through for a treaty tiebreak. We'll go through them quickly. And if one test is determinative, then you don't keep going anymore. The first one's permanent home. Which country you have a permanent home that's always available to you, and you can stay there. Then you do stay there while in that country. The next one is centers of vital interest. There are two parts: personal and economical. And if that's not determinative, you go to a habitual abode. This is where you would spend your days and nights in the respective country. And if you spend equal amount of time in both countries, then you would go to citizenship. And if you happen to be a Canadian citizen, then you would treaty tiebreak to Canada, or the other way around. Okay, and if it's not determinative up to this point, the last resort is competent authorities. That's when Canada and the US sit down together and negotiate and decide which country pulls you closer. So again, it is best that, to the extent possible, plan ahead and control your situation and your fact to make sure that that the treaty tiebreak result in what it's been most beneficial to you. So we're focusing on some people moving from Canada to the US, which are treaty countries. If you're moving to a non-treaty country, this treaty tiebreak would not be available to you. Then in that case, you really have to work on eliminating residential ties with Canada. So Canada would not treat you as a tax resident. I think we are at our polling question number 1. So the question here is, who may not be taxed as a US tax resident? Could it be a US citizen? Could it be a US green card holder? Could it be a person who drives from BC to Washington to work 5 days a week? Were they all taxed as a US resident?
Emily, that was some really good information there. And really, like you said, it's really important to make sure that you're clear on your residential standing in both Canada and the US. Canada is a lot more subjective, US is more objective, which can really result you to be considered a resident in both countries at some times. It is rare that I think in my practice anyways, that I've seen anybody get to competent authority if you are going through those treaty tiebreaker tests, which you do want to avoid because competent authority can take years to resolve issues in.
Hmm. Well, I think we have our result. Oh, what is the correct answer, Paula? I think I think this is a bit of a trick question because I only said there could be some days in the US that would be exempt for substantial presence test purposes. I didn't quite elaborate what that might be. And one of the situation is that if it's a Canadian resident or Mexico resident who would travel to the US, to work. And these would be the commuters. So these were the people who get up in the morning, drive to the US, work, and then return home to Canada to sleep. So those days present in the US would actually be excluded for a substantial presence test. So the correct answer is actually C, but it is possible. However, this person is US citizen or green card. So both C and D potentially would be correct.
I think when we meet with clients, etc., a lot of times when we're asked questions, the answer starts with "it depends," and it really does depend on certain facts and circumstances. It's never black and white. So this is a very good example of "it depends." Yeah. Okay, so on to the next section here, departure tax. So departure tax sounds worse than it is, and we do hope you feel that way after we discuss the next topics. So departure tax, when you leave Canada, you report your worldwide income up until the date that you depart Canada, and after that, you would only be taxed on income on Canadian source income from a Canadian perspective. That you are also subject to a deemed disposition of all your assets on the date that you depart Canada. And if there is an unrealized gain on your personal assets, that gain is subject to Canadian tax, which is referred to as departure tax. So there are a lot of exceptions to what is included in that deemed disposition. For example, any registered accounts would be excluded from the deemed disposition. So your RRSP, your TFSA, tax-free savings account, or if you have an RDSP, a registered educational savings plan, etc., those would not be included in departure tax. Another example of something that's not included is real property situated in Canada. So if you are deciding to keep your house in Canada, you're going to rent it out perhaps to a third party while you are becoming a non-resident, that property is not going to be subject to the deemed disposition rules for departure tax. There are some other rules that can come into play with that. And you can post security with the CRA to defer paying the departure tax. So it's a simple election that you have to make if the tax is under certain thresholds. If your tax is over a certain threshold, you do have to arrange security with the CRA, so collateral for them to have some comfort that they can collect the tax if something were to go awry. Some examples of posting security are a letter of credit, a mortgage on real property in Canada. And then one other one that's very common if you have private company shares is posting those private shares if you control those shares and have the opportunity to do that. And then the last item that we've noted on the slide is the treaty election, which also allows you to realize the deemed disposition for US tax purposes too. You may ask like, oh, why would I do that? But it is really to match the overall tax. So if you're paying tax in Canada on that deemed disposition, this election will allow you to utilize that tax as a foreign tax credit on your US return. Hopefully mitigating any US tax. And then for a future sale, you would only be subject to tax on the realized capital gain from the date you departed going forward, if that makes sense. You can also utilize your lifetime capital gains exemption if available on qualified small business corporation shares or farm property, which is also very useful in reducing or mitigating any of the departure tax. But there are some things to watch out for, as always. In 2024, the AMT rules changed a bit for capital gains. So for regular tax purposes, the capital gain inclusion is 50%. So if you have a $100,000 capital gain on those Apple shares that you've been holding on to, only $50,000 would be subject to tax, regular tax. However, for the AMT treatment, 80% is included for AMT purposes. And same with the long-term capital gains exemption. So zero, and none of the gain on those qualified small business corporation shares are subject to tax. But for AMT purposes, 30% is included. So you do really have to go through the calculation to see what your departure tax exposure is on a regular tax basis and an AMT tax basis, just so you don't have any unpleasant surprises when you actually go to file your return. And then there's just a certain number of prescribed forms that you have to file for the deemed disposition. There's 3 forms, the T1161, 1243, and then if you are making that election to defer the departure tax, there's also another form. And those forms, there is a hard deadline that you have to file them by April 30th when you file your final tax return. And the CRA can impose some additional penalties if those forms are filed late. So that is a question that we get asked quite often is when you're departing Canada is, do I need to pay this tax when I cross the border? When is this tax due? So it is due with your tax return. So April 30th of the following tax year.
So it's advisable if it's likely that you might depart from Canada, start planning and take a look at your asset and try to quantify any accrued appreciation and start thinking about what you might the implications in Canada and potentially in the US.
That's right, especially if you're wanting to post security with the CRA. As there's only certain items that they will accept, and you want to start negotiating that before the April 30th deadline, just to have the comfort that you have everything in order and there isn't going to be any surprises with that as well.
Right.
So there are some strategies to reduce departure tax or even unwind the departure tax if you come back to Canada. So departure tax can be costly if you do have some really appreciated investments, or perhaps you have private company shares that have really increased in value. So like Emily said, the pre-departure planning is really key. It's important to be proactive and not reactive if you have a deemed disposition when you leave. So some strategies is you can sell some assets. So selling them before you leave Canada would trigger the actual capital gains. It gives you better controls perhaps on maybe the foreign exchange rate, for example, and then you would have the cash to pay the tax. So again, these are just strategies. You're not required to sell your assets before you leave Canada, but it is a suggestion if you want to actually realize the capital gains instead of having the deemed disposition. You can also trigger some losses if you have, sorry, excuse me. If you have some securities that are in a loss position that you have kind of been holding on to, you just make sure you trigger those losses before your departure date. And then you can also apply the capital loss against the deemed disposition. But again, it has to be done before you leave Canada. If you sell those losses after you depart, you can't apply them against the deemed disposition. And like we just discussed, you can make the election to defer paying the departure tax. So ultimately, you defer paying the departure tax until you sell the asset, you pass away, or you can come back to Canada and then go through the unwinding of the departure tax at that time. So it is an election that you file with your tax return. And like I said, there are some common examples of what you can use to post security with the CRA. If you have private company shares, there are some strategies to reducing the fair market value before your departure. So you could consider purging your retained earnings via dividends to lower the fair market value of the net assets of the company, which is often how private company shares are valued for the deemed disposition. Not always, but that is sometimes depending on what assets, et cetera, are in the company. So then that would, if the fair market value of the net assets is lower within the company, then the value of your shares is lower. A timing of your move is a strategic move. You can really, if you have the luxury of planning your departure date, you can perhaps plan to depart when you know your portfolio is not at a gain, or you can plan to depart maybe at the first part of the year in January, February, when you don't have a lot of other income, so your marginal tax bracket is lower than if you were to move in December and have realized a whole year of taxable income. And then lastly, unwinding departure tax. So if you do return to Canada, there is a mechanism where you can unwind the departure tax. It's applicable to assets that you still own. The departure tax doesn't go away, but the calculation does adjust your cost basis for a future disposition. So effectively, you again get to defer paying the departure tax until you ultimately sell the share. So again, you can go through calculations to help dictate what that tax, or figure out what that tax might be, so you can really evaluate your options.
Paula, we often get asked, and also right now we're seeing movement between Canada and the US, and some people have deferred departure tax, but they want to know, or thinking about it, they want to know, can they unwind years later if they live in the US for 10, 20 years? Is that too far? Can they still, when they come back, and if they still have those asset, can they unwind at that time?
That's right. So as long as, no, there isn't a time limit. As long as you still own those assets, then you can go through the unwinding mechanism when you return to Canada. So I just wanted to briefly touch on maintaining a Canadian home. I know Emily is going to speak to some of the filing requirements if you were to remain or still have Canadian source income as a non-resident of Canada. But here I just really wanted to highlight that if you are a non-resident of Canada and you sell your home later, the purchaser is required to withhold 25% of the sales price. So when you sign all your documents, when you're selling your home, there is a affirmation that you need to sign that saying that you are either a tax resident or not a tax resident of Canada. If you are a non-resident, then you are not a resident of Canada, and the purchaser is required to have this 25% tax withheld. As the seller, if you know that your home perhaps was your principal residence, it wasn't a business property, and you're not actually going to owe tax at the end of the day when you actually file your tax return because of the principal residence exemption, you can file a certificate of compliance. It's a CRA form T2062. So you have up to 10 days after closing to file this form of CRA. And basically on that form, it provides a calculation of what the actual taxable capital gain will be, and then the CRA will approve, and then you'll be able to release that 25% of withholding to you. And in addition to that, you are required to file a non-resident tax return by April 30th of the following year. And also what is really come to light over the last couple of years is the BC speculation and vacancy tax. This can also apply to people that have homes in Ontario. And there's also the federal underused housing tax as well. You really want to be careful with the intricacies of the rules to ensure that you're not caught here, especially the BC speculation tax. You really have to, take a close look to make sure that just because you have left Canada and become a non-resident, if you're leaving your home vacant, you could fall into this and owe that tax, which can be quite punitive if your home is worth a lot, which I know some of those BC homes are. So it's something to be aware of, and we're well versed in those areas as well. I can always look into that for you to see what that exposure could be.
That's really good point, Paula, because we do start to see more and more of these housing related issues coming up, and these are the ones actually catching people by surprise because these are not really income tax related. But
Right.
yes, they exist, but they're relatively new, so people don't necessarily have detailed knowledge of it. One thing in particular is that we start to see that when a non-Canadian person, so not a Canadian citizen and not Canadian a permanent resident, when they sold home in Canada, CRA is actually looking at their history for underused housing tax and requiring them to actually pay the tax liability before they issue the certificate of compliance. So do be aware of it.
So the departments are really speaking to each other.
And I think as a general rule, if you do want to retain your home for whatever purpose in Canada, rent it out to external parties. And don't that generally protects you from these housing related regimes. But again, reach out to us and we can review your situation in more detail.
Yes, I agree. That brings us to our second polling question. So what is exempt from departure tax? A registered retirement savings plan, a tax-free savings account, a home in Calgary, or your employer pension plan, or E, all of the above?
Paula, do you get asked what should somebody consider when deciding whether to sell asset or close account in Canada? I think as people contemplate their move and start to evaluate their situation, they do wonder what happens if I keep RSP, TFSA. Is it better if I do? Is it better if I liquidate?
Yes.
And you talked quite a bit about former home. It is a decision that needs to be made.
Yeah, I tend to recommend consolidating accounts, closing accounts that you're not using or don't see much value in. But of course, you can keep your RSP, TFSA, etc. You do want to be mindful of the US implications of those accounts. For example, the TFSA is not tax deferred for US purposes. So definitely, again, a fact-based question really depends on the person, what assets that you have, etc.
Yeah, and for Canadian tax purposes, of course, if you liquidate your RRSP, or your employer pension, it has Canadian income tax implications. So
Exactly, exactly. So
yeah, I think our audience got it. He's right.
yeah, that's great. Okay, so just some payroll subjects now. So generally when you send employees to work in the US, it does result in either a short-term or long-term assignment. Short-term assignees, it could be an employee that maybe remains a resident of Canada, or they can sever their ties from Canada and become non-resident. So it really, again, depends on the situation. We have clients where the employer is sending a group of employees kind of on a rotational basis to the US, but they're remaining residents in Canada. But also you have clients that would have individuals just based on their facts and circumstances, if they're able to break the residential ties, they would move permanently to the US. So if it's a short-term assignee, an employee can stay on Canadian payroll, continue to pay CPP, and Canadian tax withholdings. Their work days may create a US tax filing obligation and possibly a payroll obligation as well. So it really depends on the treaty relief days in the US. You may have to run a shadow payroll in this scenario for the US obligation, etc. If the employees becomes a US tax resident or meets the substantial presence test, it is very likely that they will need to file a US tax return, and could still be a non-resident tax return under the tax treaty, but definitely they would need to file a US tax return. If the assignment is long-term in nature, this generally means that the employee will relocate permanently and join the US payroll. So they would cease Canadian payroll, US payroll with full withholdings would begin. That would include federal income tax, FICA, which is Social Security and Medicare, the equivalent of CPP, and could also include state and local taxes, just depending on their location. Of course, if you're going to Texas or Florida, there is no state tax, so that's generally a couple of states that people are quite happy to get to. They generally become a US tax resident, taxed on their worldwide income and reported in the US. And generally, from the Canadian side, the employee would become a non-resident for tax purposes, cutting the residential ties. It's really important from a payroll perspective to maintain clear documentation, assignment letters, tax residency determinations, etc. Really collaborate with the HR department, tax advisors, etc., just to make sure everybody is on the same page and aware of the tax situation in Canada and the US. From an employer perspective, you really want to be aware of your payroll obligations. Canada, the CRA often imposes, would be more for US employees coming into Canada, but Reg 102 audits, etc. And it can be quite costly if you're not on side with those payroll obligations and do come across an audit. So really important to be clear. So just the next slide there. One thing that we do find that is sometimes missed, especially on those short-term assignments, is the Social Security contributions from Canada and the US. US and Canada does have a totalization agreement where an employee can stay on Canada Pension Plan for up to 5 years if working in the US. So this can be a real savings for them, not only the employee, but also the employer, since the employer has to match the social taxes in the US. FICA is a lot more expensive than Canada Pension Plan, and having the certificate of coverage in place can really save up to $10,000 US per year for an employee. So this does have to be documented and applied for prior to leaving Canada and working on that in the US. It's a form that needs to be filed a CPT 56 with the CRA. And the employee must remain employed in Canada. So you can't have an employee that is transferred permanently to the US company. They have to stay on the Canadian payroll. So this can just be a real tax savings and often something that we find people aren't aware of or can be missed when starting to send employees down to the US. So we just wanted to mention this, not really exactly payroll related, but just on the note of tax always changes. There is the proposed big, beautiful bill that the US is proposing right now. The entire bill is still in the proposal stage, and changes could be made in the House or Senate, including elimination of this altogether. And even if this does pass, it's often open to further clarifications, etc. But right now, there's a proposed excise tax on remittance transfers. So this is a 3.5% excise tax imposed on ETF transfers when there is a non-US citizen or national sending money to a foreign country. So for example, if you have an employee in the US and they are not a US citizen, and they are sending money from the US back to Canada for a loved one, etc., this is a proposed additional cost to them that could reduce their income, and by having this 3.5% excise tax taken off of any transfer made to a foreign country. So Emily, I think it's back over to you to talk about US tax filing alternatives.
Thanks, Paula. Well, we talked about that it could be quite important to plan for your move. It's a significant event. There could be some exposures in the case of a departure tax. There could be opportunities. A part of the planning is it's determining if a timing makes a difference. When you want to cease your Canadian tax residency and when you become a US tax resident. And if it is important, plan for it and plan around taxable event potentially. For example, part of that, do you have capital gain, capital dividend in your Canadian corporation? Do you want to dividend that out? Whether there's timing related to that. Do you have stock options that you want to exercise before or after your move? So part of that also is because the year of transition is interesting and typically more complex. One part of it is that there could be US different filing alternatives. If you are not a US person, not a US citizen, not a US green card holder, in the year of transition, it is possible that you didn't meet a substantial presence test. You would be non-resident alien of the US. And in which case you would remain a Canadian tax resident. Is that beneficial for you to do? Or if you did meet your substantial presence test, or if you make that your first year choice, you would be treated as a part-year resident of the US. So before you move to the US, you'd be subject to Canadian tax on a worldwide basis. And then you'd be generally taxed as a non-resident of Canada for the second part of the year. And it's the other way around in the US, that once you become a US tax resident, you'd be subject to US tax on a worldwide basis, federally and potentially statewide as well. There's also another approach, and this often happens when it's for a married couple. That if, for example, if the couple moves from Canada to the US, and so at the beginning of the year they're non-resident of the US, and the end of the year they would be a US resident, assuming they made substantial presence test. They could make an election to be treated as full year tax resident of the US, and the main purpose of doing that is to file joint US tax returns. In Canada, individuals file separate tax returns, and we have a limited ability to split income between a married couple. In the US, there's a choice for a couple to file jointly or file separately. And often tax liability could be lower when a couple file jointly versus separately. So for that purpose, you could make an election under Internal Revenue Code 6013 to be treated as a tax resident. Okay, so and then there's another one as well. So that one is more geared towards, for example, when one spouse moved to the US and another spouse remain in Canada, and that spouse in Canada would be non-resident alien of the US, as long as the spouse that moved to the US become a US tax resident, they could make a joint election to be treated to both be treated as a full year resident of the US, again, typically to file jointly. So it is available for people, two people in that situation, but there are a number of things to be considered. Making the election, is it beneficial to you? If you result in lower tax in the US, how about in Canada? You want to achieve a situation where your overall tax liability could be reduced by making the election, and also taking into consideration other implications for the non-resident, for the Canadian resident spouse. If this person is treated as a US tax resident, this person would be subject to full US reporting obligation, which can be quite onerous, and there would be potentially penalty exposures if it's not correctly filed too. So there's a cost benefit analysis to be done, but it is available to some people, and if it should be made, the election should be made if it is beneficial. The election, again, it has to be made jointly by both spouses, and it can only be made once. So now we successfully navigated the first year of move. Once you cease Canadian tax residency, it is still possible that you still have Canadian tax obligations. There are certain type of income from Canada that would be exempt once a person becomes a non-resident of Canada. A common example is interest from Canadian sources. It would not be subject to Canadian tax and as a regular or withholding tax. And if the person retires in the US and receives CPP or old age securities, that income is only taxed in the US, not in Canada. What remains taxable in Canada? Well, there are a number of them. One is that especially if the person is traveling between Canada and the US and still working in Canada. Under Canadian tax rules, services rendered in Canada for employment purposes is taxable in Canada, unless exempt under the treaty. And if this person has a business income and for business carried on in Canada through a permanent establishment in Canada, and in which case the business income could still be subject to Canadian tax. we spent quite a bit of time talking about if a person retains real property in Canada. So something interesting happens when that happens. If you decide to retain your former home in Canada and rent it out, as a non-resident of Canada, the default rule is that 25% of the gross rental income should be withheld and remitted on timely basis to CRA. And if you're satisfied with that, that could be your ultimate Canadian tax liability. Or there are typically expenses associated with owning a home. You could file Canadian tax return and elect to be taxed on based on graduate rate on net rental income. So again, that's a decision to be made. If the rental income is relatively low, maybe 25% is not too different from associated with compared to compliance cost, really. But otherwise, it may make sense to file that elective return. Again, failing to withhold and it could be subject to penalty. So if you are deciding to rent out your former home in Canada, as you cease Canadian residency, talk to us or speak to a tax advisor. Okay. So another thing is that if you have an employer pension, that continues to be taxable when it's distributed. If you have an employer pension and if you keep it in Canada, it is, however, tax deferred in both countries until it is withdrawn. The one difference is that watch out for RSP and the state requirement. For example, we have clients moving to California. California does not comply with U.S. federal requirements. So if you have RSP generating income, that income is actually taxable for state purposes in California. And there are also income subject to withholding as well. That includes Canadian dividend and royalties. So let's take a look at withholding requirement. This is what's referred to as Part 13 tax. Okay, so after you move and you receive income from Canadian corporations, rent, royalty, pension, annuity, there is withholding requirement. So it is important that as you move out of the country, advise your Canadian payer that you're moving to the US, you're going to become US tax resident. So they, in theory, should correctly withhold. It doesn't always happen, however, even though you've done your part and advise your Canadian bank or financial advisor that you're moving out, that there are still times that the withholding is either insufficient or over, that if they didn't go by treaty reduced rate, that they could over assess. So, but if they did withhold correctly, then you don't have any further Canadian tax obligations. You don't need to file Canadian tax return. Okay.
I
But
find that especially in the first year, and then it generally moves out after that. But
yeah, I also have seen people the Canadian payer withheld correctly for a few years, and then something happened, and the treatment changed. Then they go back and have to fix it. So if there's over withholding, you do need to contact the CRA and file this form NR7R to request for a refund. And if there's insufficient withholding, you again have to write to the CRA and remit the amount that's under withheld. So it could happen, but we can help you to resolve that. So, so you could still be subject to Canadian tax or tax in other countries once you become a U.S. Person. And once that happens, of course, we know you're subject to U.S. tax on worldwide basis as a resident, a citizen, or permanent resident of the U.S. And Canadian source income could continue to subject to Canadian tax. That's when foreign tax credit becomes important. Foreign tax credit is there, and, and particularly under the treaty, to avoid double taxation in Canada and the US. And that's when you have to really start looking at the sourcing of the income. So generally speaking, that is, there are exceptions as always. So if income is sourced to Canada, for example, rental and or Canadian um, pension income, then Canada has that first right to tax the income, and the U.S. would allow foreign tax credit for your Canadian tax liability to reduce your U.S. at least federal income tax liability on that income. Watch out for states, different, well, unlike Canadian provinces, where we typically get used to file a return, T1, that calculate both federal and provincial income tax. US is different. Oh, well, Quebec is an exception as well.
Emily, I
You-
think that we need to hop into the last and final polling question, just because we're getting so close to the top of the hour. And
Oh, okay,
yeah,
let's do that. But
yeah.
just yeah, just keep in mind, foreign tax credit is there to help you to avoid double taxation. But let's jump to the polling question.
So which income earned by a non-resident of Canada is subject to Canadian withholding? Rent from Canadian real property, dividend from a Canadian corporation, Canadian employer pension income, proceeds from sale of former home, or our favorite answer is all of the above. So again, a lot of information that you covered there, Emily, and super important. Obviously, the treaty is there to mitigate or reduce any risk of double taxation. So that does really help people in these situations.
Mm-hmm. And clients often ask, what is it okay to keep in Canada? And that's something we can work through. And the important thing is understand the implications of
Mhm.
keeping versus disposing of something in both countries.
Right.
Oh, wow. That's impressive.
Okay, so we just have a couple quick slides, and I realized that we aren't going to get to your questions that have been entered into the Q&A chat. We will try to respond to those after the presentation. If you don't get a response to your question, please reach out to myself or Emily directly. Happy to answer those questions for you, and apologize that we didn't have more time. So I'm not going to spend too much time on this slide just because it is a bit more involved in explaining, but the main key is that if you have private company shares, so a Canadian corporation that you hold shares in, you really have to do effective planning before you leave Canada, before you become subject to tax in the US. So if you have this situation, please reach out to us and we can provide you that advice that you need to minimize your overall tax if you have that. So our last slide of the day is just like a summary of kind of best practices. Obviously, we really encourage pre-departure tax briefings with your cross-border tax professional. As an employer, this is a great thing that you can offer to your employee. Tax is often a very stressful part of moving and not in their wheelhouse. So obviously you want to make the move from Canada to the US as smooth as possible. Employees might have the impression that the US is very similar to Canada. What do I need to know? But obviously you can tell from the presentation there are a lot of tax differences that really make a big difference and can cause those surprises that that you don't want an employee to experience. So we offer that service. We're happy to do that. So please reach out. It's really important to understand the residency rules and timing. If you have that home in Canada, really important that you're aware of what to do if you sell it as a non-resident. And then lastly, we didn't touch on this in the presentation, but just delaying your green card or US citizenship, because that can also have further tax implications down the road. And you can refer to another webinar on that subject, or happy to reach out to us and we can expand on that. So last but not least, please complete the survey and just thank you very much for attending. We really appreciate you spending the time today. Thanks, everyone.
Thank you.